pretty clear to most people at this point that the housing market is finally undergoing a significant fundamental reversal in activity. So now bear in mind that it's not sort of, this tremendously draconian backdrop where all of a sudden, houses are just, sitting and twisting in the wind for months and quarters on end, like they were, in 2011. But clearly, we are seeing a dramatic shift in the backdrop. So, transitioning from basically best ever to, what's, could sort of probably be best described as less good is really sort of reflected in this slide 17 chart from Redfin. So this is basically a vintage level analysis of the percent of homes on a weekly basis that are cutting their listing or asking price. And you can see 2019 there in blue, sort of your baseline. There is some seasonality to these numbers. You can see that sort of trend over the course of the year in fairly consistent ways. You see how the market got tighter in 2020 versus 2019, the red line there coming in below the blue line. And then you can see the orange line 2021 coming in below the red line up until about mid-year. The black line there, of course, is 2022. 2022 started out just fine for the first basically 3 or 4 months. But it's really over the last 2 months that things have started to sort of, go hockey stick higher. And as a reminder, this is the percentage of homes on a weekly basis cutting their listing price. So obviously hockey sticking higher is sort of the inverse of what's happening fundamentally, meaning that things are clearly getting worse on the margin. So an important barometer there. If we go to the next slide, this is a slide from Ed Pinto at the AEI, or American Enterprise Institute. He is a quarterly speaker that we host in our housing segment, housing vertical. And this is one slide from, he usually presents about 20 to 30 slides each quarter. Then we spend about a half hour sort of rolling through Q&A. And this is one slide that I thought was interesting this quarter and sort of dovetails. So it has to do with basically the sort of risk backdrop in the housing market. And it goes back, this chart does, to 2012. And basically we're looking at the stressed NMDR across the different major categories of housing risk concentration. So NMDR is national mortgage default rate. So essentially, this is your leading indicator for how much fallout or default you're probabilistically going to see across these different risk buckets. So there's sort of good news and bad news here. The good news is that the levels at which Fannie and Freddie are running, and the VA for that matter, are all really quite tight. So that should make people feel pretty good that the backdrop for the housing market from a default risk standpoint is not what you're starting to read about in the headlines. The caveat here is FHA. So the red line at the top is the FHA, and that stressed NMDR is now at 29%, which is actually right around the peak level of where it had been just prior to the start of the pandemic. For context, in 2005, 2006, that stressed NMDR at FHA would have been in the low to mid 30%. So we're not quite there, but we're definitely at a high level of FHA stress. And so if you are going to see correction in the housing market from a default standpoint, it's going to be in the FHA. And the areas to sort of keep an eye on would be cities and, more specifically, metro level and zip code level areas where there are elevated concentrations of FHA finance properties, because those would be the areas where you could start to see a little bit of price weakness contagion as default rates pick up in those markets. So I just wanted to differentiate there between the GSEs and the FHA from a risk backdrop standpoint.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.